Good afternoon, everybody. Can you hear me now?
Yes, good afternoon, sir.
Happy Sunday to you all. So today we're just going to dive in. We have looked at a whole lot, but it may not appear so from your own angle, considering the fact that we are still yet to solve a whole question from past question. Now, the reason for that, I don't know if I've ever explained. The reason for that is because when you delve into a typical past question, you would have so many angles, so many, so many angles that if they have not been touched already in class, it would appear as though I am speaking Spanish. And I know there are first timers amongst us. Some of us may have written the paper before. That will give us some level of edge in terms of understanding what we are going to be doing. However, even if you're a first timer, I want to believe that you've done FR already, and that the fact that we have built some level of foundation should also help us. All right. So the class for today is um, is totally dedicated towards solving at least a past question. Now, typically in the exam,
Without them realizing.
okay, in the exam, you are going to have 195 minutes. That's 3 hours, 15 minutes. Okay, meaning that if you're going to be solving four questions, if you're going to be doing four questions, you have about less than 50 minutes to answer each question. Now, typically, if a question would take 30 minutes to solve for you in the class, we might use an hour. In the typical classroom, we might use an hour. That's a physical class, or let's say 45 minutes thereabouts. In a virtual class, because of the limited space I have to solve and maybe network impediments here and there, it takes close to 2 hours to solve. So if you look at it, it means that we have such a very short opportunity or time for us to do as many questions together. But what I would say is perhaps we can have one or two, maybe three extra classes that will be dedicated to question solving. All right, let's get into it. This is a typical consolidation question, and it's not too far back. It was 2 days ago. It was set in November 2023. I would have solved the earlier one. Maybe that would have even taken less time. But I said, let's do consolidation. Let's do a question that asks us to do consolidation. So this question asks us to do consolidation, and it takes 30 marks altogether. All you have to do is prepare the consolidated statement of financial position for Sport PLC Group as at September 30th, 2020. All right, let's go into it. Okay, we are told question one, Sports PLC is a company which operates in the service sector. Now, Sports PLC has business relationship with Football PLC and Volleyball PLC. The financial positions of these companies as at September 30th, 2020 are stated below. All right. So given the non-current assets, we can already see when you look at investment in subsidiary, we can already see here that Sport made investment in Football PLC. Okay, Volleyball PLC under Football PLC, meaning that Football PLC also made an investment in Volleyball PLC, and then we see investment in handball. We're going to look into that whole mix. What does that represent? Intangible assets were given, all of that culminates into the um, total assets you have there. Equities and liabilities. I'm just looking at what the statement of financial position looks like before I begin to read the additional information. All right, notice one thing. I started from what is the requirement of the question. And now everything I'm reading here, I'll try to link to that. I'm to do consolidation. They have only just told me that there is a relationship between Sport PLC, Football PLC, Volleyball PLC. Now, my very high level of, wait, oh, am I sharing my screen? We all have the question, but let me share the screen, sorry. So my very high level of inquisition will already say, notice that I didn't see handball in the introductory paragraph. Okay. Who has made this investment in handball? It looks like it's Sport PLC. I'm seeing 96 here. Okay. I'll be asking myself, what does 96 represent there? Could it be associate investment? Could it be just an investment under IFRS 9, just an equity investment on the assets? So those are I'm just trying to make you get a feel of what your level of inquisition should look like when you're reading the questions. You're studying the statement of financial positions of the company. All right. We move further. Now we're giving the following information, and we're told it is relevant to the preparation of the group's financial statement. They're very nice. They have told you this information you have that we are giving you. We are not just giving you for the sake of you to make adjustments in the separate books. We are asking you because it's going to be relevant in consolidating the financial statement of the group. And we read the requirement. The requirement is very straightforward. Just prepare the consolidated statement of financial position. All right, let's go on. As we go on, what I like to do is when I'm reading a question to establish what are the things that will flesh out in my calculations. Okay, so I may be making some points as we read on and on. All right, let's go on. First point there, we're told on October 1st, 2018, Sports PLC acquired 70% of the equity interest of Football PLC. The purchase consideration consisted of cash of 1.46 billion. All right. At acquisition, the fair value of the non-controlling interest in Football PLC was 590 million. Now, this already tells me that, um, it is very likely because they have given me the fair value of NCI. It is very likely that at the end of the day, what they will tell me is that I should, this is what I'm referring to. What they are going to tell me is very likely that they will ask me to value NCI at fair value. All right. On October 1st, 2018, the fair value of the identifiable net assets acquired was 1,670 million. All right. And retained earnings were 638 million. Then we have other components of equity summed up altogether, 54 million. Typical me, what I would just do is to quickly go and check my SOFP. Was it stated that way? Yes, they stated it all together. Other components of equity. I would want to know if that was broken down, if they gave me the detailed other other components of equity. Maybe they gave me revaluation reserve, share premium. Did they give me broken down or did they put it together? All right, so they put it together, no problem. And now they have told me the excess in fair value is due to non-depreciable land, right? So if I were you in the exam, or what I would do, this whole paragraph, I need to shorten it. How do I do that? Very simple. We have controlling interest to the tune of 70%. NCI would represent 30%. Now, the cost of this acquisition was 1,460,000. Of course, you don't write that on your question booklet. You don't write it there. Or if you're going to write at all, make sure you're writing in pencil, all right? So that you can easily erase. You're just shorthanding the information you have there. And if you have an examiner that has told you, do not write on it, just use the back of your question paper, find that space. This is 590 million because there's going to be a lot of information. When I need information from here, I want to be able to pick it directly without being distracted. All right. Now I've been told the net identifiable assets is 1,670 million. All right. But what I would do again is I would want to write my date of acquisition. My date of acquisition was October 1st, 2018. All right. Now, when I do all of this, something tells me, guy, they mentioned fair value. All right. Fair value excess, which was due to non-depreciable land. All right, good. So I don't even have to do any depreciation on that fair value excess. However, I may want to ask myself, if you have already told me the total net identifiable asset is 1.67 billion, and you've already told me what is retained earnings there, you've already told me what is other component of equity, I can say retained earnings pre-acquisition is 638 million. I can say other component of equity is equal to 54 million. Now, what is something that is standard that must be part of the net identifiable assets is ordinary share capital. So I can quickly look at the statement of financial position. Ordinary share capital for Football PLC is 800 million. If you look at ordinary share capital under Football PLC, 800 million. So it quickly tells me here that this should be 800 million. If you add all of this together, it will not be up to this. Now, the excess fair value they are referring to will be the difference between this 1.6 billion and whatever this totals. If you do 638 plus 54 plus 800, you get 1492. Take that away from 1670, you immediately have 180. So I know the value is 178. I'm still going to work this out in the solution, but I kind of understand what I'm expected to do with this information, but I need this information. When I start my solution, I want to be able to pick it at once so that all the other information will not confuse me. All right, it's straightforward now. I can go ahead and do the same for the next note. For the next note, as I would understand it, I have been told we acquired Football PLC now has acquired 80%. I'll do the same thing, 80% NCI here. Now I've told you when a subsidiary buys equity investment or equity interest in another company, what matters to us really is not the NCI there. What matters to us is going to be the NCI for the whole group. So I know that, but I'm just going to, so I won't dwell on NCI for this one. I just want to remind myself, okay, we bought 80%. Yeah, it definitely means there's a 20% NCI there, but I'll come back to that. I'm not going to do all of those analysis. Okay, The consideration we paid was 640 million, or Football PLC paid was 640 million. Okay, we're giving the fair value of the non-controlling interest there is 144 million. It's not going to be the strongest thing I need. 30%, we're giving 44%. Okay, we'll come back to this. I might just underline this. If I were you, I'll just underline this. I'll come back to whatever it implies. I don't know for now. I'll come back to it. At the date of acquisition, don't forget, date of acquisition here is October 1st, 2019. All right. We're giving the net identifiable net asset. All of it is 720. Net asset 724 rather million. And we're told retained earnings were 212, OCI 40. So OCE 40, retained earnings 212. So from here, I know I'm going to have a similar calculation I did. I go back to ordinary share capital. Whatever the ordinary share capital is, I know if I add them together, this 724 is going to be higher than it. Because I'm seeing here excess in fair value is due to non-depreciable land as well. Thank God I don't have to depreciate. Okay, now they now said it is a group policy to measure non-controlling assets. Non-controlling interest at fair value at date of acquisition. All right, I'm going to do something similar there. I think I don't have a problem with the first two additional information they have given. Do we understand everything I have said? Do we understand? When I say we're going to do something similar in first additional information and second additional information, is it clear? Is it clear? Is it clear? You can use the chat box if you are shy to speak. Mr. Hosseini, is it clear?
Yes, it's clear.
All right. Okay, let's move on. And then, where's my... All right. So we're told additional information 3, both Football PLC and Volleyball PLC were tested for impairment as at September 30th, 2020. And we were told the recoverable amount. Let me clear this. The recoverable amount of both cash generating units as stated in the individual statement as at September 30th, 2020 were Football PLC 2.85 billion, Volleyball PLC 1.208 billion, respectively. The directors of Sport PLC felt that any impairment of assets was due to poor performance of the intangible assets. All right. So we're going to relate this impairment to intangible assets. Okay. And they have already said cash generating units. So I know it's going to be impairment assets that we're going to look at. All right. The recoverable amount has been determined without consideration of liabilities which relates to the financing of operations. All right. Okay, what is all this English about? If I can immediately interpret it somehow, I will. If I can't, I know I have a problem here. But I'll say maybe if I read further, I'll be able to come back. Something might help me to come back to this. But let me just explain because of time so that we don't waste time when we get there. When you look at an asset, you know that by principle, IAS1, even right back to when you were doing financial accounting at foundation level, or when you were in an undergraduate, maybe you studied accounting, you know that we don't like to overvalue assets. We don't like to overstate our assets. An accountant will also never overstate, will try as much to never overstate our income, all right? And the reason for that is prudence, right? Now, so in that same principle, you have impairment. Impairment will be charged on any assets if we consider that the recoverability of that asset is lower than the book value. What do? We impair. So what I should be looking at in this instance is the total assets. All right. The total assets I was given for the two companies. The total asset for Football PLC is 2,260,000. Total asset for Volleyball PLC is 1,190,000. However, there could be adjustments that will still affect these total assets. So I cannot pick these values yet. After I've looked at it and I have seen the effect of this adjustment, I'll come back to this impairment and say the recoverable amount, is it lower? I mean, is it low? Yeah, is it lower than the book value of these assets? If it now turns out that the recoverable amount is an amount that is lower than the adjusted total assets, then I will need to calculate an impairment. And it's very simple. I'll just say whatever the adjusted total asset is compared to the recoverable amount, the difference is what I will charge as an impairment loss. Right? That's what I will charge as an impairment loss. And if there is any goodwill on consolidation of these companies, it is going to be the goodwill that will first of all suffer that impairment loss, meaning I will first of all charge it away from goodwill before I go to any other asset. I don't know if Mr. Aswe has taught you IAS 36. That's the order with which you will allocate impairments. You must have done it under IAS 36. Let's move on. Sport PLC acquired a 14% interest in Handball PLC on October 1, 2018 for a cash consideration of 36 million. Now, this is a simple investment. Simple investment. Why? Because the investment is 14%. Remember that I made mention of handball, that they didn't mention it in the opening statement of this question. Now they are now telling us about it. So they made a 14% interest investment. This equity will regard it as accretion of wealth. It will be under the scope of IFRS 9, but we know that IFRS 9 would always have, there are three options under IFRS. There's amortized cost, there's fair value through POL, there's fair value through OCI. All right. Now, particularly for equity, it's going to be one of the last two. Either we are doing fair value through POL or we are doing fair value through OCI. Okay, we're told the investment was accounted for under IFRS 9, just like I mentioned, financial instrument, and was designated as fair value through OCI. Okay. On April 1, 2020, Sport PLC acquired additional 16% interest in Handball PLC for cash consideration of 54 million and achieved significant influence. Okay. Immediately they tell you that they achieved significant influence. Oh, it means that they want you to treat it as an investment associate, right? But do they meet the cutoff? Yeah, they used to have 14%. Now they have additional 16%, bringing the total holdings in Handball PLC to 30%. They have crossed the 20% mark, and examiner has told you, I think it was this class I mentioned it. At times, examiner will intentionally tell you not to treat as an associate. So look out for that. But if they did not mention at all, immediately you pass the 20% mark, treat it as investment in associate. And what does that mean? It means we're going to account for it using equity account. Equity accounting. And what does that mean? What does it mean is that I am going to look at what is it called now? The investment made at the historical amount. The investment, I'm going to add share of profit. I will deduct any dividend received and then any impairments as well. Whatever is my balance is what will represent my investment in an associate. So we'll come back to it when we go into solution fully. Okay, now we're told that we paid 54 million and we achieved significant influence. All right. You can already tell that brings our total investment to 36 plus 54, about 90 million. Now, the value of the original 14% on April 1, 2020 was 42 million. All right. Meaning that there must have been a fair value increase of 6 million naira. All right. We'll come back to that as well. That increase, we're going to be treating this, we would have been treating this actually at that point in time. When did they say this happened? They said April 1st, 2020. Okay. The day we will start treating it as an associate is that very day. However, that very day as well, until that day, we would have been treating as IFRS 9. And the IFRS 9 option that this company has chosen is fair value through OCI. So it means that the 6 million fair value gain will go to their OCI, to go to the company's OCI. It will increase the value of their investment, but it will be credited to their OCI or OCE in this case, other component of equity. All right. Then we're told the value, okay, we're told Anvil PLC made a profit after tax of 40 million and 60 million. All right. We're going to go into the analysis of how much Sport PLC will get of this profit after tax. Now it will be accounted for. We'll see it. Okay, we're told on September 20, Sport PLC received dividend from Anvil PLC of 4 million. This will go straight, which was credited to their OCI, their other component of equity. All right. This dividend is going to reduce our investment. All right, because the assumption will be that it is a transaction between the group, within the group. So we will cancel it out. Or you can also look at it like this: for the sake of the group, we don't wait until they pay us dividend in equity accounting. So what we would have done is that year on year, as they were making their profit, we use the share of the profit that belongs to Sport PLC to increase their investment. So when dividend is paid, you have already accounted for that element of dividend that was paid. So you just subtract it. That's another way to look at it. All right. Additional information 5, we're told Sport PLC purchased patent of 20 million. Let me take my annotations earlier. Okay. We're told Sport PLC purchased 20 million naira, patents to use in a project to develop new products on October 1, 2019. And Sport PLC has completed the investigative phase of the project, incurring an additional 14 million. Okay, this investigative cost will not qualify for what is it called now? It will not qualify for what is it called capitalization. Is investigative cost that you have incurred. And as it's just like you're making a research cost, any research cost, investigative cost, all those things, we normally expense them under IAS 38. Okay, but we're told that and as determined that the product will be developed profitably. Okay, any cost you now incur after now is no longer part of the investigative cost. That should be expense. Those ones can now be capitalized. right? An effective and working prototype was created, a cost of 8 million. If they capitalize this is correct. And in order to put the product into condition for sale, okay, further 6 million, all right, this can be capitalized as well. They say finally, marketing cost. Marketing cost of 4 million were incurred. We have already developed the asset. This marketing cost is going to be expensed. If they had earlier capitalized this, which looks like what they have earlier done, this will need to be expensed. We will need to take it off. All right. All of the above costs were included. Okay. Now, what they are saying is the 14 million, no, the 20 million, no, the 8 million, all the costs they mentioned here were already included in the intangible assets of Sport PLC. Now, by our judgment, we already know using IES 38 that investigative costs or research costs, those costs you have not identified at that point in time that this product you are trying to develop. So at that point in time, any cost you incur at that preliminary stage is going to be expense. When you have now developed, you have gone past the stage of assessing, you are no longer doing feasibility study. You are sure now that what you are spending on will turn into an asset for you. You can make money off it. All right, good. You can go ahead and capitalize. After you are done capitalizing, it ends there. After you are done developing the product, it ends. Any further cost on marketing, all those other ones, those logistic costs, whatever cost you incur further should be expense. Okay. Note number 6, we're told Sport PLC intends to dispose of a major line of the patent business operation. At the date the held for sale criteria was met, the carrying amount of the asset and liabilities consisting of the line of business were PPE, inventories, current asset, that is trade payables. All right, okay. We'll just calculate the net asset here. What is the net asset we have according to our books? Have this plus this minus this. All right, okay. And then we're told it is anticipated that Sport PLC will realize what they can recover. Their realizable value is 60 million. I'm sure the book value of this operating line is higher than 60 million. So it already means there's going to be an impairment here. We are going to impair this, right? For those of us who may be asking, what does it mean? This held for sale, I don't know if you've done it with Mr. IFRS 5, asset held for sale, non-current asset held for sale, and discontinued operation. That knowledge is needed here. So this is why one of the reasons why I say solving the past question require you to have done some other topics, right? But this is not more than we can handle, okay? So they said no adjustment have been made, okay? They have not made an adjustment. Then we need to make the adjustment for this impairment, all right? All right. Another thing we must bear in mind, for every adjustment you make, you must ask yourself, who is going to take this adjustment? Is it the parent? Is it a transaction or an adjustment that is solely for the parent? That is the nature of adjustment, additional information number 6 and additional information number 5. This does not concern any other member of the group. It's only the parent. The parents made associate investments and they bought patent. So number 4, number 5, number 6. I must bear in mind when I'm doing this adjustment, it's only going to go to the parent. It does not affect NCI at all. But if there is any impairment on football PLC or volleyball PLC, I should know that because we are using a policy that says fair value, whenever the NCI is measured at full or fair value, we already know that any impairment on goodwill in itself is going to be shared between the parent and the NCI. Then any impairment that affects the goodwill that was earlier recognized should also affect both the parent and NCI. Now, if anything also affects the profit of that subsidiary, whether it is NCI proportionate or whatever, we already know that such adjustment that affects the subsidiary will affect both the parent and the NCI because the both of them that invested. Right? Let's go into solving this question quite a lot, but it's 30 marks and we have to do it. All right. Do we all have, I wish I had sent this question earlier. Okay. Let me try this. If I can quickly screenshot the question and send to us on the group. Is that okay? Okay. First thing first, like we have said, especially because we find out something. You will agree with me that there is a case where, first of all, Sport PLC invested in Football PLC. Football PLC now invested in Volleyball PLC. Equity interest here is 70%. Equity interest here is 80%. Did I represent the question well? Like this? This is what we said. We said whenever this happens, this is a subsidiary. This will be a subsidiary. Now, it means that Sport PLC, we have an indirect holding or interest to the tune of 70% multiplied by 80%. Now, if you do 0.7 times 0.8, you get 0.5. Okay? Meaning you have 56%. And then NCI in volleyball should be 44% altogether. We can do the analysis of this 44%, but we don't need it. Is this clear, everybody? We must be clear on this one first before we start. We've done this one before. All right. Now, if you go to the question, you can begin to solve. But because we've done this something similar, I don't think that should be a problem for us. Let's start with goodwill. Let's start with goodwill. Goodwill on consolidation of the two companies. Okay, there is Football PLC. And then there is Volleyball PLC. Consideration. Let's go back to the question. How much did we pay to buy investments? How much did we pay to buy investment in Football PLC?
1460.
Thank you. 1460. I'm sure they gave us the fair value of NCI. So let's not waste time. What is the value of NCI? 590. Good. All right. If you add all of that together, what do we get? This is
050.
2050. Now,
What
the
do you want?
net identifiable net
Where
assets.
What is he doing? He's reading.
Net assets as at that day was how much? Net
167
assets. One what?
1670.
1670. My goodwill should be how much?
380.
380 million. Okay. I'll come back to this. 380 million. All right. Now let's do for volleyball. For volleyball, what I taught you in class is this, that you must look at it from this angle. It is not, what is so important is not the investment that Football PLC has made in volleyball. What matters to us is the implication of that indirect investment that Sport PLC now has made. How did they make an indirect investment? Football PLC is a subsidiary of Sport PLC. Now, Football PLC made an investment to the tune that they have controlling interest in it. What does that mean for our group account? We said it here, that it means that we have an indirect interest to the tune of 56%. So I will say to myself, if they paid 56%, if Football PLC has made 640 million consideration, so what
Yes.
is 56% of 640? Oh, sorry. Not 56. What is, sorry?
It's
70%.
We own 70% in Football PLC. So if they made thank you. If they made an investment of 640, we can assume that 70% of that 640 million is our asset. All right. So, all right. Now, so what is 70% of that?
448.
All right. So that will be the consideration I will use. I won't use 640. Trying to use this to this out. All right. 448. Now be careful. What did we say? As long as for the group, the NCI is 44%. All right.
Yes.
Now you will notice in the additional information, they gave you the fair value for 44%.
They give for 20.
So they gave you for 20, they gave you for 30, they gave you for 44.
Yes.
Now, why they have done that, ICAN has done that because they know that you could possibly be confused. So if you had used...
But why would they do that? That's wicked. Yes, now. It's wickedness now. Just give us for top state and let us move on.
Sorry, sir, for the consideration, why didn't you use 56%?
Why didn't you use 56%? Okay, I'll come back to that. All right. We must consider all of that 640 million that was paid. Now, that 640 that was paid, 70%, we're going to assume that that cash that Football PLC paid to volleyball, we own 70% of the assets and liabilities of Football PLC. So 70% of that cash belongs to us. The remaining 30% belongs to the NCI. And we are still going to treat that remaining 30% when we are valuing the NCI under volleyball. Is it clear now? Is it clear?
Somehow.
We will not do 56%. We're going to do all of that 70% that they own.
I thought the 70% was for like sports and football, between sport and football.
But who paid that consideration? It was Football PLC. Do you understand? So 70% of that cash that Football PLC paid, we assume that it is for Sport PLC. Do you understand what I'm saying? Now, when you want to do this is different from if Football PLC wants to do consolidation of volleyball. That would be a group that would include Football PLC and volleyball alone. You do everything. But as long as this is concerned, you're only going to take the consideration for the parent company now, being Sport PLC, to be 70% of that cash that was paid. However, when it comes to NCI, the NCI is 44%. And in the question, they give you the fair value for 44%. So you don't have any excuse. I was laughing because you were saying it like, why would they do that? Why would they give you? Of course, they are trying to test. If they give you 44% straight, it's very easy. But if we give you 20%, we give you 30%. Somebody will say, Shebi, I have used 70% here. Let me do 30% that remain. Somebody else will say, Football PLC made 80%, forgetting that it is not the investment of Football PLC, the holdings of Football PLC that matters in this instance now. 20%, the remaining 20%, another person will do that mistake. But there will be somebody who really knows, who has been taught and who really knows. That person is the one that will just pick that 44%. That will happen. That will always happen. All right. So 44%, what's the fair value for 44%?
322.
32. So if we add this together, what do we get?
770.
770. All right, what's the net asset? What's the net asset that we're giving there?
724.
724. It is at this point that we're going to have 46 here. Now, mind you, you could have gone ahead. I agree with you. I will agree with you. Under examination condition, you could have closed this off and go on. But this is the importance of going through all of the additional information. If you close it off, no problem. But don't always forget something. It is very common at this level that they will give you something like impairment of goodwill. So I'll keep this open. I'll ask myself, is there any impairment? If there is no impairment, my answer remains the same. But I have to give it a chance that there could be an impairment. Is this clear? All we have done so far is very simple and straightforward. Is this clear? Hello, let us talk. Is this clear?
Yes,
Yes,
so far
sir.
so good.
Or does it look simpler than it should be?
No.
I don't think it does. It's straightforward. Now, what you might have as a question in your mind is around, why did I use this net asset direct? Are we not forgetting anything? Yeah, we're not really forgetting anything. They already told you that excess fair value is a non-depreciable land. Now, if you have told me it's a non-depreciable land, it means I don't have to worry my head about the depreciation. And even if I was to worry my head about the depreciation is not coming here. It will go to group retained earnings, all right? And then it will affect the assets, all right? But now they said it's non-depreciable. So that is taken away. I don't have to bother about that. The only thing I have to bother about is if there's going to be an impairment of goodwill. Now, the question did not tell me that there is an impairment of goodwill, but the question did mention that there is an impairment on that there is an impairment test. They did not say that there is an impairment, but they say there is an impairment test. And now that impairment test was done to the cash generating unit. The cash generating unit of Football PLC, and volleyball PLC.
Yeah.
So now I need to be careful. Why? Because I need to carry out that test myself. How do I carry out that test? I said, look at the total asset of the two companies. If there's any adjustment to the assets, do the adjustment to the assets. Look at what that brings you to. So you will now have an adjusted total asset value. Now compare your adjusted total value asset to the amount they told you is the recoverable amount from the assets of the two companies. If the recoverable amount is lower than the adjusted total asset value, then that means there must be an impairment. So what do? We will reduce the total asset of that company to the recoverable amount. It's as simple as that. That's what impairment is about. Impairment is about recoverability. And that is the reason why, even for, I don't know, I think I saw Mr. Asu taking ECL yesterday or CR physical class. I don't know if he has gotten to that with you. The reason you calculate expected credit loss is because you are considering what will be the recoverability of this asset. You don't do it for financial instruments. You do it, okay? You don't do it for securities alone. You do it also for receivables. Yeah. How much do we expect that we're going to be able to recover from these assets? If it is lower than the book value, then we must do an impairment. So even ECL is a form of impairment. You understand? All right. Let's a lot more complex. I think they give us more and more stuff that is affecting the assets. I have to. Please, I can't hear you well. Coming from Chidima. Chidima, can you hear me better now? Can I use the chat box? Okay, so let's go back to the question. There are how many additional information there? How many additional informations are there? I think there are about 7.
There was 6.
6, okay. You and I agree that all of the information in 4, 5, 6 relates to Sport PLC, right? Information 1 and information 2 relates to calculation of goodwill. Information 3 is telling us about this impairment. So therefore, I don't have, it means my how I'm processing it is that, okay, I have more information that deals with Sport PLC than I have information that deal with the other subsidiaries. So it's something I can quickly go and check. I can quickly calculate this impairment. All right? Because the only thing that can possibly affect the asset of the subsidiaries is this fair value adjustment that we have just. That's the only thing they have mentioned in the question so far that relates to the assets of the two subsidiary companies. Is this clear? So I can easily come here and say, permit me to erase this one. And it's important though. I want to trust that my students. Okay. Chidima, you said no. Can you hear me better now? I'm sorry, I'm tired a bit, but I will try as much as I can.
I hear you when you say, can you hear me? But apart from that, your voice is very low.
All right. Okay. How about now?
Goes okay. Yeah. Was okay.
All right. So this is what I was saying. I was saying that I can easily access whether there will be plenty adjustment that affects the total assets of the two subsidiaries. Because I have looked at all the additional information they gave me. There were only 6 of them. The first 2 was speaking to the subsidiaries and how I'm going to calculate my goodwill. The third one is the one that told me that there was an impairment test, and they gave me the recoverable amount of the assets of Football PLC and that of Volleyball PLC. All right. The remaining 3 after that belong to Sport PLC. So that already tells me that if there is any adjustment that is going to impact the total asset, which I must consider before I will compare with the recoverable amount. If there's any adjustment at all, I should have seen it by now. It must have been mentioned as at point 3. So this is what I'm going to do. I'll say impairment test. Impairment test. Let's do the impairment test together. Impairment test. Impairment tests. For the two companies, there's football and then there's volleyball. Now their total assets, according to the question. Somebody have me look at the question. What's their total asset there?
Okay. Football is 2260.
2260.
And then volleyball is 1190.
1190. All right. Now, both of them have fair value adjustment. All right. Fair value adjustment. Okay. For football PLC, they said 54. No, sorry. We need to calculate that. Abi, they both have. They have excess in fair value, which is due to non-depreciable land. All right. I'll come back to this. So let me see if I can do it here. Fair value adjustments. The net assets for football PLC and then volleyball. Football PLC net asset was 1,670. All right. Volleyball was 724 naira million. Naira million. So this is 724. Now, ordinary share capital was how much? Ordinary share capital of football PLC. How much? I can see 800 here.
800.
For volleyball, 400. Now, pre-acquisition retained earnings as at the day of acquisition. The pre-acquisition retained earnings was how much? Retained earnings, 638. Abi?
Yes, sir.
For football. For volleyball, they said 212.
212.
All right. Then other component of equity. This one was 54. For what is it called now? Volleyball was 40. Now let's do the math. The rest, if their net asset is this much, I am sure when you add 800 plus 638 plus 54, what do you get? Just do that one alone. 800 plus 638 plus 54. What do you get?
Your mouth is going from the microphone or whatever. I cannot hear you.
I said when you add 800 plus 638 plus 54, what do you get?
1492.
1492.
You can see that the net asset that you have calculated is not up to what they said is the net asset. So what is left is the fair value adjustment. So please help me do 1670 minus 1492. 170. Thank you. God bless you. 170. Now do the same for volleyball. If you do the same for volleyball, this is 252 plus this is 752. I mean,
Volleyball
652. So 724 minus 652. What do you get?
72. Emerald.
72. All right. So here I have 178. Here I have 72. If I add this together, the adjusted total assets is how much? Adjusted total asset is how much? This is 8, 3, 4. Is it 4? Somebody help me with this.
2438, yes, 2.
2438.
Yeah.
1262.
1262. Now, this will not be all. We have had goodwill, Abby. We had goodwill. That goodwill will not have shown on, I have told you many times. It will never shown this. All right. Okay. But we have a goodwill of 380 here. And we have one of 46 here. All right. How much do we have here altogether? 8182. How much do we have here? 8031. Okay. Now, how much did they tell us is the recoverable amount for Football PLC?
2850.
PLC. 2850. This is
Yeah.
Are we getting what we are doing, please?
Yes,
Yes, sir.
we are testing for a payment.
Good. Recoverable is 2850. Recoverable here is 1208. If this is the case, if you are in financial reporting in your company, the auditor will say, Augusta, of Volleyball PLC, it will be impossible for us to go ahead and say our total asset is 1308 when the recoverable amount is 1208. So therefore, there should be an impairment there. But for Football PLC, the what is it called now? The recoverable amount is still higher than the book value. So there will be no impairment there, but there will be an impairment under volleyball. All right. So can we go ahead and do the impairment for volleyball? Impairment for volleyball. Let me erase this. I've shown you how we got the fair value there. The impairment for volleyball.
What are you doing outside?
So here I can say no impairment. Here there will be what? Impairment. No impairment. For football, there is impairment for volleyball. Now, our impairment loss will be equals to that total asset value minus the recoverable amount. And that will be 1308 minus 1208. What you have is 100 million. Now, you must also not forget that this 100 million applies to intangible assets. How do you allocate this 100 million? You must never forget. You will first of all allocate to goodwill, if anything like that exists. All right. So goodwill is to the tune of how much? 46 million. All of this goodwill will be impaired. I'll take it out like this. We have discovered that there is no impairment here. So my goodwill here is still 380. But I will come here and say, all right, no wahala. This 100 million, this impairment will be shared between NCI and parents. All right. So my group retained earnings, I'll debit my group retained earnings. Don't forget that we have an indirect interest in volleyball to the tune of 56%. We'll debit this 56 million. We'll debit NCI. NCI is 44%. You collect 44. What do we credit? We are going to credit goodwill first, which we have done, 46 million. Now, what is left? The remaining will go to the intangible assets. 54 million. All right, is this clear?
Please, can you take it again?
All right, I said this 100 million, they told us it applies to CGU, all right, cash generating assets, cash generating units. All right, so I said you will need to allocate your impairments. To further understand what I'm saying, you may need to go and revise IAS 36 very well. Just read allocation of goodwill, allocation of impairments to cash generating units. The first thing it will touch, if there is anything like that is goodwill, you will first of all go and apply it to the goodwill, and you apply it to the other assets. Now, I said 46 is the goodwill, and this impairment is higher than 46. So all of that 46 will be impaired. The remaining will now go to, they told us that the remaining should go to intangible assets. Okay, so the remaining goes to intangible assets. However, for the debit side, all of this cannot go to group retaining because, first of all, it is not only the group the parent company that will take all of the losses. The loss is affecting a subsidiary. But because it is a sub-subsidiary, it is that indirect holding that I'm going to apply 56%. The remaining 44% will now go to NCI. I think that's clear now. Is it clear now?
Yeah, but your voice sometimes will just go low. Just sound low.
But did you get my explanation? If you didn't get it, I don't mind re-explaining.
Your explanation, I got it that we will allocate it to goodwill first. So for the 46 would offset. So we have it will end off. So the remaining one, you said we'll take it to intangible assets.
Yes.
So from there, I didn't hear you from
okay, I'm now saying that for the debit side, right? You know, it's a loss. It's a loss. You should go to your P&L. So for the group retained earnings, only 56% can go to group. You know why? Because the indirect holding of Sport PLC in volleyball is only 56%. The remaining 44% will go to NCI. Is it clear now?
Yes, please. Thank you.
All right, good. So for goodwill, I can say we have achieved goodwill. We have achieved how to go about goodwill. All right. So the next, we've treated number 1, number 2, additional information. We've gone ahead to treat number 3, additional information. Let's go to number 4, additional information now. This one, this remaining 3, we need to take it one by one so that we don't miss out. Let's go to additional information number 4. I would like us to read it. Additional information number 4. We're told Sport PLC acquired 14% interest in Handball PLC. On which day? October 1st, 2018. Can I erase this one that we've done, all the workings we've done so far?
Now, will this also be sent to us later?
No, you have the solution. It's a past question. The solution is there. We're just walking through it together. I don't know if you get what I'm saying.
Yes, I get it.
So the solution is in your, I understand that some of us may still be looking at the solution and still not understand what was done there. But the reason I'm doing it on a plain sheet like this is so that we can do the walkthrough together. When we do the walkthrough, and it's not just that we are looking at the solution, everybody will understand how A was gotten, how B was gotten, and how they will present it in their exam. All right. First thing first, at least we have achieved goodwill. That one is clear. We have achieved the impairment and we have treated it very well. All right. Okay. So let's go on. The only thing is if I have, I stopped sharing. The only thing is if I have any reason not to agree with what was done in their solution, I would have made that clear to you. I would have said it that, I'm going to do a totally different thing. All right. Okay, let's move on. So let's go there. Let's take it step by step. We're told that Sport PLC acquired. I hope everybody can hear me now.
Yes.
All right. We're told Sport PLC acquired 14% interest in handball on October 1st, 2018 for a cash consideration of 36 million. Okay. The investment was accounted. Okay, before we even go on, this is what I like to do. My SOFP for Sport PLC, investment in handball PLC, there is 96 million. So,
We cannot hear you again, no. I'm talking to you.
in handball, how much? 36 million.
We didn't hear you for some time.
All right. All right. I said, even if that 14% did not meet the threshold to qualify as an investment in associate, they will still go ahead at least and debit investment in handball, 36 million. Abi? All right, good. Let's move on from there. We're now told that the investment was accounted for under IFRS 9 financial instrument and was designated as fair value through OCI. The meaning of this is that through OCI means any increase in the value of the shares that they invested in, the equity they bought, will be accounted for, not in the profit or loss account. It will be accounted for in the OCI, and it will speak in your SOFP under other components of equity. It is possible some companies will specifically mention it, reserve, a specific reserve for fair value revaluation of equity instrument. We have a component of equity like that, and it will be accounting for any changes in the value of their investment. Now, this is strictly IFRS 9. It does not have anything to do with investment in associates yet. Why? Because the investment as of now is only 14%. All right. They have made 36 million naira investment. Then we go further. We're now told that on April 1st, 2020, Sport PLC acquired additional 16% interest in handball PLC for a cash consideration of 54 million. Their investment has now grown to how much? 54 million. This one was 14%. This now is 16%. But mind you, when they get 16% additional, the total holding will be 14 plus 16, and it will equal 30%. Now, what date was that? It was April 1st, 2020. From April 1st, 2020, they begin to account for it because they said it gave them significant influence. That significant influence is the hint that you need for you to know that you are now going to start accounting for it under equity accounting. Do you understand now? So from that date, you begin to account for it under equity accounting. Now, you are going to consolidate whatever they are getting from these associates. You are going to consolidate their investment there. The only thing is that the way you will calculate your carrying amount of investment, I will show you under equity accounting. And I'm sure you have done it in FR. So it's not all new. It's not new to you. I am going to consolidate it, but it will not be full consolidation. The only things I am going to consolidate will be just two things. What are the two things? Under assets, I will consolidate the carrying amount of our investment in associates. Under equity, under my group retained earnings, I am going to consolidate my share of profit in associates. That is all that I am going to consolidate here. So you need to be careful to ensure that from this day, that is how you will account for it. Now, what about prior to that day? Prior to that day, I am only going to get that revenue, that revaluation surplus. I'm only going to account for it. I'm only going to account for that revaluation surplus. If the question told me that in those years, any dividend was paid, then they would have accounted for it as part of the things that the group got. All right, but let's move forward. Let's move forward. I want to believe it is clear what I explained as regards not doing full consolidation. You are only consolidating the carrying amount of the investment in associates and any share of profit in the associates. Okay. Let's add what other thing did they add there? They now said that Anvil PLC made profit after tax of 40 million and 60 million for the years to September 30th, 2019 and September 30th, 2020, respectively. So what they made, that 40 million that they made in 2019 is not going to be consolidated. What you will do is you will take you only take a profit that was shared as dividend. All right. However, for 2020, there's a 60 million naira there. Okay, for that 2020, from April 1st down to September 30th. How many months is that? I'll count April, May, June, July, August, September. I have counted 6 months. So for those 6 months, they are going to have to consolidate the share of profit. 6 months out of 60 million multiplied by 30%. That's what we're going to do there. It's so easy and straightforward. All right, we're now told that I missed something out. Okay, they said the value of the original 14% investment on April 1st, 2020 was 42 million. All right, this 36 million is now 42 million. So I can say fair value adjustment here. 42 minus 36, that's additional 6 million. This is how they got 96 million. This is how they got 96 million. Is this clear? Is this clear to us? Do we understand it? So now, immediately now, I can go ahead and do what? I can go ahead and determine what is the carrying amount of our investment in Anko, right? I can go ahead and do that. I've already started the work. I can either pick it from the question and go ahead with what other information I have, or I can do the breakdown like this to say, I understand how you got to 96 million. Now, what is the share of profit? I like to call it SOFIE. Share, SOPIE rather, share of profit in associates. I said you are going to do count from April to September, is 6 months.
That would be the right, the 96 million.
Okay, let me go back again. They said we bought in 2018. We bought for 36 million, 14%. Then 2020, we bought additional 16% for 54 million. Is there in the question? Look at additional information number 4. They now said the one we bought earlier that used to be 36 million, the fair value, those shares now worth 42 million. All right. So those ones that we bought earlier, that was 36 million. The value is now, that was 36 million. The value is now 42. Meaning that there's going to be a fair value adjustment. How do I treat this? They told me that this treatment is for fair value through other comprehensive income. So I will credit other comprehensive income, 6 million, other comprehensive, other component of equity, 6 million, and then I will debit the investment to increase the value of the investment by 6 million. All right, that's how we got 96 million there. So when they say carrying amount, I want to teach you how you're going to calculate carrying amount under investment in associates now. So what's their share of the profit? Okay, the day they became associates was 1st April 2020. Okay, you now count from that day. April, the whole of April, because it was April 1. The whole of April is 1 month. May is the 2nd month. June is the 2nd month and 3rd month. July is the 4th month. August is the 5th month. September is the 6th month. So that's 6 months out of the 12 months for the year. 6 over 12. Then we multiply that by how much was the profit they made in the year ending September 2020. They made 60 million. All right. But what is their own percentage holding? They now have a total percentage holding of 30%. How did I get 30%? They bought additional 16. 14, 14 plus 16. That gives you 30%. Clear now.
Yeah, but Mr.
Is this clear
please
now?
can you mute your mic?
So anybody, let me see if I can.
Please, can you say what percent again?
Can I take what again? Oh, please, I didn't hear you very well. Can you say what you said? Can you ask your question again?
30%.
How we got 30%?
Yes.
I said, look at the question again. Go back to the additional information. You still need to go back there. 14% was what we had initially. I said that 14%. It does not meet the threshold for it to be, for us to have significant, right? Significant influence will start from 20% up to an amount, any amount that is less than 50%. Abi? Now, but if we have 14%, we don't have it. Yeah, good. So we would account for it using IFRS 9. They told us of all the policies we can choose under IFRS 9, they chose fair value through OCI. All right. We don't have a problem with that. But April 1, 2020, they bought additional 16%. Don't forget, if they add 14% and they have now bought additional 16%, it means that they will now qualify for significant influence. And that's exactly what the question told us. Now they now qualify for significant influence, meaning they now have an investment in associates. It's no longer for accretion of wealth. It's now an investment in associates. 30%. That's how they got the 30%. Now the implication of the 30%, let me come back again. I said the implication of the 30% being an investment in associates means one thing, that we are going to use equity accounting to measure their investment and any share of profit that they are going to get. Now, what's the meaning of equity accounting? It just means that I am not going to do full consolidation. What is full consolidation? Full consolidation is what we were doing, what we do when we add line by line items of assets and liabilities. When we are doing that, what we are doing is full consolidation. We won't do that for associates. We won't do that for the assets and liabilities of an board. What we are going to do there is that we're going to calculate the carrying amount using equity accounting. We'll calculate the carrying amount of the investment in associates. We'll consolidate that. Only that. And then we'll go to the share of profit that we have from our investment in associates. We'll also consolidate that. Those are the only two things I'm going to touch. Every other thing, I will not touch their assets. I will not touch their liabilities. Is this clear now? Is this clear, ma?
Yes,
Hello,
thank you.
everyone. All right. Okay. Now, what is this value? 6/12 times 60 has to be 30. 30 times 30%. That's 9 million. Abi? So that's how we'll get 9 million there. So this will be 9 million. All right. I said, if they paid you dividend, the dividend they are paying you in 2020, they paid us dividend. But we have already taken all that is due to us. That is how we do equity accounting. In equity accounting, we don't wait until the company we invested in pays dividend. We already have accumulated all the profit that is due to us. But remember that the company that we invested in may choose not to pay dividend. They may choose to pay only part of their profit as dividends. They may as well choose to pay all of the profit that they made and pay dividends to everybody. Now, the implication of this 9 million we did here is that this is all that belongs to us. This is all that belongs to us in Handball PLC. All that we are entitled to is 9 million. However, Handball PLC, in the prudency of their management, they decided that they are not going to share all of their profits. So the only dividend they gave us was 4 million. So not to double count that 4 million we have received, what we are going to do, for the sake of our group account, we are going to deduct this 4 million. We are going to deduct this 4 million. Now, another way, the way it was explained under, what is it called now? IFRS 10, is that this 4 million that, sorry, I said 5 million. This 4 million that you were paid will represent a transaction that has taken place between members of the group. Now, why did they say that? Is because in as much as you are not doing full consolidation, you are still taking the numbers that you have from an associate into the group account. So in one way or the other, even the associate is still a member of the group. Do you get what I'm saying? So you will treat it as the same way you were treating transactions that happens within the group, and you cancel out any profit, any intra-group profit, cancel it out. Remember, when you were doing FR, you would cancel it out to the tune of the investment in associate. So that's what you were just doing. That's just what we are doing here. But even a very simpler way to look at it is that to say Oh, I have added 9 million. This is all of the profit that is due to us. So if they now decided to pay us 4 million, I have already accounted for that 4 million in that 9 million. So I need to deduct it. This is straightforward. All right. This is going to be my investment. This is going to be my investment in handball when I will go to the group. See, there's a particular question I saw. I think it was FR's class I saw it. How you will account for this in the separate book? You see this 96 million in the book of Sport PLC, in the separate book of Sport PLC, they will continue to carry 96 million. However, when it comes to equity accounting, this is how you will do it. You add all the profits that are due to you. If there's any impairment, this is where you will treat it inside the carrying amount. Anything that improves or anything that is a loss or that is a gain, you come and treat it. If they tell you that there's any transaction that took place between Sport PLC and the associates handbook, any adjustment you want to do, you will come here and do the second leg. It will affect the group retained earnings, and then it will come here as the second leg, either to increase it or to decrease it. That is why investment in associates is very easy. All right, so I'm going to move on. Now, don't forget where this is going to go to. The second leg of this 9 million is your group retained earnings, which we're going to do very soon. We need to treat the other additional information first. All right. What other additional information do we have? Additional information number 5. What were we told there? Additional information number 5. What did they tell us there? They told us that Sport PLC purchased patents of 20 million naira to use in a project to develop new products on October 1st, 2019. Sport PLC has completed the investigative phase of the project, incurring an additional cost of 14 million naira, and has determined that the product can be developed profitably. This is the point where you begin to capitalize. But let's move forward. We don't know what the question is saying. An effective and working prototype was created at a cost of 8 million naira. We went into production already. And in order to put the product into condition that is suitable for sale, a further 6 million naira was spent. This is capitalized. And finally, marketing costs of 4 million naira were incurred. Okay, this does not represent a cost in creating an asset that is separate. We have done production. This other cost of marketing is going to be expensive. All right. But what did they tell us? They said all of the above costs, all of the above costs, we are included in the intangible assets of Sport PLC, meaning that we have gone ahead to capitalize all of these costs. Marketing costs, we have determined it should not be capitalized, it should be expense. Another cost that should be expense, they may have said investigative. All of that is still under research. And we know that research cost on its own is also supposed to be expensed under IAS 38. This one may require you to go back, to go and revise IAS 38. The same way when we were treating goodwill, and I was talking about allocation of goodwill in terms of CGU, I said you might need to go back to go and revise IAS 36. All right. Now, such is the requirement of this paper. You must be very sound with standard, because it will always show up in almost all the questions you are going to do. This is your opportunity to prepare for diploma in IFRS. For many of us, I would advise you, once you are done with this paper, or once you are done with this, what is it called? Exam, don't be like me. I should have gone ahead and go and do diploma in IFRS, but I'll be doing it by the special grace of God this year. So because you're already very sound to an extent, just go for another exam or another program that will improve your understanding on standards. Okay, let's go ahead. Let's treat it. All we want to do is that we are going to expense. Expense the following: marketing costs, what, 14 million. Research, or you can call it research, was 40 expense. Okay, how do we do that? So I will just debit group retained earnings. I'm going to subtract 18 million there. Oh God, my battery is low. And I'm going to credit, what am I crediting now? Intangible assets. They should not have capitalized this to the tune of how much? 18 million. All right. What's the last, the very last? What was the very last item we have there? Let's look at that additional information. It was something about held for sale. All right. Okay, let's say Spur PLC intends to dispose of a major line of the patents business operation. All right. At the date the held for sale criteria were met. Okay, I'm sure. Let me ask, have you done IFRS 5? Let me know how much comment I should make.
Not yet, sir.
Have you? Not yet. Okay, don't worry. Mr. Wasi will take you IFRS 5. Under IFRS 5, there are criteria that will be met. What this is just saying is that there is a line of operation, there is a business operation that they want to sell. They want to sell. And immediately you want to sell such assets, you will not account for it under wherever it is. If it is a PPE, you will take it off, because it will not be there as if you are hoping that in the future is when you are going to, the system of recovering the value of that PPE is that you are keeping it in your books, and you are saying, as I'm using the asset. If you say an asset is held for sale, it means that you no longer want to continue to use it. So therefore, you cannot continue to account for it as a PPE. What you will do is that you credit it off PPE and you will now debit held for sale. Held for sale meaning that you are hoping that very soon you are going to dispose of, and then it's not going to be a non-current asset. It is now a current asset. Why? Because you are expecting that you are going to realize the value of that asset in a very short period of time. So that accountants will not bastardize this interpretation. The standard IFRS 5 gave guidance as to the criteria before you will categorize an asset as held for sale. All right. Today is not the day for that. You're going to have that class fully with Mr. Wasiu. All right. Well, let's move on to it now. It has met that criteria, so no problem about the criteria. What are these assets? They itemized them. They told us that the asset and liabilities under this business operation, we have PPE of 36 million, we have inventories of 98 million, we have current liability of 6 million. All of these, I'm going to take them away from those respective lines, and I will take it to held for sale. Right? So what we have, the book value of what is held for sale is going to be 36 million plus 98 million. 6 million is a liability, so I'll minus. That gives me how much?
128.
128 million. All right. But what did they tell me? Is the realizable value. They told me the net realizable value is 60 million. So therefore, our impairment here is going to be an impairment loss
68 million.
of 128 million, which is the book value, minus how much they say is realizable? 60 million.
Yeah.
So even when you are going to recognize this N for C, you cannot recognize 128 because like I mentioned earlier, how much can you possibly realize or recover from the asset? The total amount you can recover is 60 million. So we will take off 68 million naira. All right. So that's what we're going to do. So it's clear now that we have dealt with all of this. But before I move on, what is the implication of this 68 million? These discontinued operations is going to affect our group retained earnings, Abi, because it is only for the parent. So group retained earnings will be affected 68 million. And then we're going to credit discontinued operations.
No disposal.
68 million. All right. Okay, we have dealt with everything now. So what do? I can simply go ahead and calculate because a lot of things are going to go into my group retained earnings. A lot of things will go there. So I can simply go ahead now and deal with them. All right. So permit me from here. My battery is quite low. Let me see how many percent I have left. I have 18% left. That should still carry me to the end. But this is what we are going to do. This is how we are going to run it. Let's run it like this. Let's go back to the solution. We'll go and look at the group retained earnings in the solution. All of these things we have dealt with. Okay, let's do it this way. Sorry. Can I erase all of this now? Can I erase everything?
Yes.
We'll try. We'll try as much as we can. I'm not sure I can remember everything. One mind is saying, let me just try. I'm not sure I can remember everything.
Sorry, please, I have a question.
Okay, go ahead.
In note 5, why didn't we consider the 6 million that was spent?
6 million that was spent. Let me go to note 5 to start with, so I can be on the same page. Note 5. A further 6 million was spent. Now that 6 million, let's read it from the beginning of the sentence. They said an effective and working prototype was considered at 8 million. No, it's note 5 she's referring to. Yeah, I know what she's saying now.
Now this is capitalized.
Don't worry, sir. Let me explain. Now, an effective and working prototype was created at a cost of 8 million. This effective and working, they have told you they qualified it, is an effective and working prototype. Before you will go into scaling up in production, you will first of all create something that, can this work? Yes, if it can work, good. You are developing something. Good. So they have told us it's effective and it's working, and it's a prototype. So that cost of 8 million, we will capitalize it. If you don't have a problem with us capitalizing 8 million, the further 6 million that was spent, then you should agree with us to capitalize it as well. You know why? Because it is still part of this. Okay, we spent 8 million. Then we realized that, for us to carry it on, we needed to spend additional 6 million. The same principle that says we should capitalize 8 million is that same principle that will tell us to capitalize the additional 6 million. Is this clear now?
Yeah.
Okay, good. You're welcome. So group retained earnings. I didn't want to look at their solution to do it because I remember we don't do it the same way. They have separated it. I want to combine it in one place. And I'm hoping that You will not come back and tell me that you prefer the separate one. I want to do it that way because that's what we've always been doing in class. Okay, so we have sports PLC, we have football, and then we have volleyball. All right. Now, as of 30th 9 20 what? What's that date? 2020. Let's look at the retained earnings of each one of them. We still have to do NCIO. All right. The retained earnings of each one of them. Sport PLC 1790. Football PLC, you can look at, I'm picking from the SOFP that they gave me in the question.
960.
As at 30th 9 2020. All right. Let's go there. Let me go there. 884 for football and 278 for volleyball. All right. Now, pre-acquisition for football was how much? 638 million. Pre-acquisition for volleyball,
212.
212 million. All right. Okay. Good. That means that the post-acquisition that we are going to share here, we have 246 million. Here we have how much now? $66 million. Right. Good. Now, no time to waste. No time to waste. Share of post-acquisition. Share of post-acquisition. We get, is it 70% now?
Yes, for football, 70%.
Of 246. What do we get?
172.
172. That's what we get. All right. For volleyball,
56%.
we are only going to get 56% of 66. What do we get there?
37.
That will lead us to 37. All right. Okay. Now, don't forget that we also have associates. In associates, we said you do 6/12 times 60 million. We have already done this earlier.
30%, that's 9.
Okay, we got 9. Thank you. We got 9. All right. Now, let's not forget that there was an impairment.
Yeah.
We calculated impairment the other time, and I told you, the impairment, if I recall, was 100 million naira in total. You said parents would get 56%, which is all right, isn't it? So the impairment loss of 56 million will come here. Do we understand this, or do we record this? Do we understand this? Do we understand this before I go further? Do we understand this before I go further?
Yes, sir.
All right. Now, don't also forget that we expensed some things, Abi.
Yes.
Under R&D, we expensed a total of 18 million. Let me write this one very well. 18 million naira was expensed there. So that's another jacket of 18. All right. Now, let's also not forget, we just did this for now. There's a discontinued operation. All right. Discontinued operation. Under the discontinued operation, we said there's going to be an impairment on the assets that were held for sale. All right. Now, the assets that were held for sale, the operating line.
68.
Okay, thank you. Oh, thank you so much. So 68. All right. Now let's close this off by adding 1790 plus 172. 1790 plus 172 plus 37 plus 9 plus, okay, minus 56 minus 18 minus 58. Clear get?
1,871.
1,000?
871.
871. Shikina. As simple as that. Now let's come to NCI. Or before we even go to NCI, so that I don't forget this one. Let's look at other. OC. As I was mentioning OC now, something just came to my head.
So we can't really hear you.
Okay, did you hear me up until the conclusion of group retained earnings?
Yes, yes.
Okay, that's good. All right, let's go to OCE. And I'm hoping I have not forgotten some things there. Now, sorry, we have sports PLC, we have football, and lastly, who else do we have there?
Volleyball.
Volleyball. Not enough space, but I must manage. Volleyball. Okay, according to our SOFP, what do we have under these lines? As at 2020, end of our accounting year in 2020,
146.
OCE is 146 here.
74.
Naira million. For football, 74. For volley, 50. Now, what is the pre-acquisition here? Pre-acquisition, 54.
And 40.
Pre-acquisition under volley,
40.
40, thank you. Sorry, sir, that 1871 is 1866. I thought it was 58, the asset held for sale. So it's 1866.
1866. All right. So pre-acquisition here. This one should be 20. I mean, post-acquisition rather.
Post. I just want the way you say pre. That's post.
Post-acquisition, all right? Now, share. Let me quickly share. Football, we get 70%.
All right.
And that will be 14.
Yes.
Volley. We'll get how many?
56%.
56.
we'll get 56. Now, if we get 56 there,
Fix.
that will be 5.6. Abi?
Round it off to 6.
If you round it up to 6, where did we do the earlier second leg? Have you done a second leg before? Okay, the second leg will go to the other part, will go to NCI. I'm trying to ensure that we will not do the O value in one place and then approximate in another place. We have not touched it before, Abi? Have we? We have not. We have not. We've not touched it before. All right, no voila. I can do 6. No problem. But if you do something like this, please let your examiner know. Point it out to him that that's what you've done. Okay, 6 million. What else? What else? I must not forget too that there was a. Remember, we said that for that 14% equity investment we made, that they would have used IFRS 9 and any fair value adjustment will go to OCI. Right now, the representation of OCI on the financial position, statement of financial position, is going to be OCI. Remember, I used to tell you in class that the representation of P&L is retained earnings. In that same vein, the representation of OCI will be, according to this question, other component of equity. So that's where I'll take it. OCA. All right. So I'll bring it here. That's 6 million that we got. Fair value adjustment on equity. 6 million, not in space. Is there any other thing that should be OCI?
Dividend received from associates.
Oh, the dividend that we got paid from associates. We did not treat it under group retained earnings, right? Because that such is the nature of their policy. All right. So we'll bring it here. Dividend received. Dividend. Just manage me, please. If you take out that 4, I think that's all. So 146 plus 14 plus 6 plus 6 minus 4. Is that 186? Or what do you get? This fair value here will be a deduction. Sorry.
Why are we bringing the fair value in OCA?
Yes, now, because they told you earlier that equity investment to be treated as fair value through OCI. All right. It will be treated as fair value through OCI. And now said that your representation of OCI, your representation of OCI is the OCE on the financial. Let me come back to what I said earlier. If anything affects P&L and you are treating statement of financial position, where are you going to show that effect? You show that effect under retained earnings. Have you now?
Yes.
Is that not what you do?
Yes, yes.
Okay. So now, when it is something that should be OCI, but you are not working with OCI, you are not working with statement of profit or loss and OCI. What you are working with is the statement of financial position. So you look out for which element of equity should represent that OCI. Now, usually you will have something called revaluation reserve. So if you go there, But this question puts all of their other component of equity together and called it other component of equity. Yes, and that's why we are bringing it here. Is it clear now?
Okay.
That your okay sounds like it's not clear.
Let's just move on.
And me, I want to be sure
Please
that you are
come
clear.
again. Please come again, sir. Please come again.
So what I'm saying is that by now, you'll be used to situations where you are treating consolidated statement of financial condition.
We can't
Everything
hear
that
you,
you
sir.
Sir, your
How about
audio.
now? How about now? Hello, how about
Yes, we
now?
can hear you now. We can hear you
So
now.
I
We can hear you
said,
now.
by now you'll be used to situations where whatever you are dealing with, all right, that has to do with an adjustment to your P&L, all right? But because you don't have P&L, you are dealing with statement of financial position, consolidated statement of financial position. What you do is you take such adjustments to retain earnings. Why? Because all the
That you're still
profit or
far
loss,
from the mic.
hey, Jesus. Because all the profit
Yes.
or losses, is it better now? Because all the profit or losses that you make year on year is accumulated into your retained earnings. All right. The only part where you don't retain, you pay as dividend. Abi? Or there is a prior year adjustment. Even your prior year adjustment will affect the retained earnings. Okay. So, and your retained earnings is where? It's represented on the statement of financial position. I'm not saying in the same vein, when you credit OCI, where does it go to? It goes to your revaluation reserve. That revaluation reserve is because we have made a distinction between P&L and OCI. All right. So it goes to your extent. The question did not mention revaluation reserve. You take it to retained earnings. Most questions are like that. Okay, maybe that is what's causing your confusion. But typically, it goes to your revaluation reserve. I even mentioned it in this class that for some companies, what you will do is they will have a specific line of reserve that will warehouse any revaluation gains or losses in your equity because they are doing fair value through OCI for their equities. Do you understand? So it's not so difficult, it's not so different. So this time around, we're going to say that, okay, now that we have done one leg, which is to increase the value of that asset by that 6 million, all right? And don't forget, at that point, we have not even started using equity accounting. But there was a fair value adjustment that affected the asset. The other leg for it will now go to the group other component of equity. Is it clear now? No, no, answering you. Is it clear now? I'll move on. I'll assume either it is clear or that you will figure it out, whichever one of the two. So this is where we are right now. The only thing left, which we must do with some level of, let me see if I can do it. Is NCI, because there is something I kept hammering on when we were doing it in class that you must not forget for your NCI. NCI is not so hard. All of these other ones that we've done, all of these other ones that we've done or that we have treated that affected the payment that is supposed to be shared between them, also going to go. The one thing you must not forget is the cost of investment. That consideration that football PLC paid to volleyball 640. We took only 70% in calculation of our goodwill. The remaining 30% of that 640 is still going to come into our under consideration of NCI. So let's quickly try and do NCI. Can I erase everything here?
Yes, sir.
My battery is running low, so let me quickly do that. It means that we will need a special class to do the other question. Thursday is acceptable by, better be Friday. Class with FR, so that I can move them forward as well. All right. For NCI, non-controlling interest. This is what I'm going to do. NCI in volleyball, we have NCI in football. Football, volleyball. Now, as at the day of acquisition, DOA, as at the date of acquisition, what was the value of NCI? Go. All right, well, let's go to
590. 590.
590. Thank you.
Volleyball is 322.
Thank you. So if I were you, that one that I said you must never forget, that's the first thing I would deal with, because that's what I usually use. Because I know myself, I can easily forget that. Cost of investment. If I deal with any other thing, cost of investment. Football PLC paid 640 million. We have dealt with the earlier 70%. How much is this 30%? 192 million naira. All right. Now, there's an impairment on goodwill. We said out of the 100 million, 56 million should go to the parents. We treated that under group retained earnings. We completed all of that. But the remaining 44 million will come here. Is this clear? Is this clear? Share of profits, SOP. Share of profits. I have the solution. I'm just going to go ahead and tell us. This one, let me break it up so that it is clear.
44% of 54.
I'm coming.
No.
Post-acquisition profit. Post-acquisition profit for football PLC was 248, if I'm correct. I think it was 248. I'm trying, okay, it was 246. I'm looking through my solution now. 246 times 30%. For volleyball, it was...
No. Is that 246 or 266? That's for football.
For football, it was 246. Profit alone, without including other components of equity. Profit alone was 246. I'm looking through my solution. I did a solution separate as well. I've taken that solution now. For volleyball 72, NCIA is 44%. If you calculate this, how much do we get? Here we have approximately 74. Sorry. Here we have approximately 74. Here we're going to have approximately 29. Now for share of OCE, football, post-acquisition was 20. So 30% of 20. And that will give me 6. For volleyball, I'll do 44% of 10. We approximated the other time. So 4.4, I will take it as 4. So you add, you close off. 590 plus 74 plus 6. That's 80 plus 590. That should be 670. 670. That will be the value of NCI under football PLC. Now, under volleyball PLC, this is 33 minus 192 plus 4. I think I had 119 here. So this is going to be the values of our NCI. Now, don't worry. Let's go to the question. I understand for some numbers we approximated. I'll just say screens. So when you come to the solution, I think we can see all the numbers that we have worked with there. So the first, my battery is low. The first additions we have here were the PPE numbers. You will go back and look at it. The PPE numbers we had, this was the fair value adjustment, 71, 78, and 72. 36 there, minus 36 there, we'll be referring to the PPE of that discontinued operation. You know, I told you that you will take it off there, you will take it to held for sale. All right. And you will see that held for sale here. See, discontinued operation is here now. Under non-current and under current, I said you will take it away from there, you take it to current assets. All right. Investment in subsidiaries. We have taken that all away. We've used that to get the amount of goodwill that we have. The goodwill comes here. You will see that that goodwill is only 380. It's the one we got under football. The one we got under volleyball has been fully impaired. All right. Investment in handball, we've already seen that in our calculation was 101, I remember. Intangible assets, this is the one for sport, for football, for handball. And then don't forget that the impairment to cash generating units, 54 million out of 100, 46 we used it to reduce totally all the goodwill we had. The remaining 54 is what the minus here. This 18 minus 18, don't forget there was a 14 million and the 4 million we said were capitalized but should be expensed. That's that minus 18 there. 18 there. Current asset, this is that of sports, that of football, that of volleyball. This minus 98, I said that operating line, let me just show you once and for all so that it doesn't look like, this is what I'm referring to. Additional information 6. You can see inventories 98, 36, 6. I said all this one, you are going to take them away from that place. You will take it to held for sale. In this case, it's discontinued operation. So that's why they are showing it under discontinued. All those things, all they add together there. And then they also took out that 66. They took out that 68 million. All right. Now, ordinary share, that is that of the parent. Other component, we got, when we did other component, I think we got 155. Approximation is why they have that. Our retained earnings. be maybe 1866. I don't know why we have 1866. I think initially we had 1871. There must have been a confusion as regards. I remember we later changed it. So non-controlling interest, we just calculated that we had 670 and 119. Right. I'll see what I can do to bring out. Okay, what I will do is I'll watch the recording of this. I'll pick all the numbers and then I'll give you the solution. That's what I'm going to do. And I will see whether our own numbers will balance. I expect it to balance. It should. Non-current liabilities. Don't forget non-current liabilities, that will go. We just add everything. Current liabilities is what I wanted to mention. Don't forget that this -6 will be referring to the discontinued operation. So I would have even done the discontinued operation and bring -6 here. But what they have done, they brought discontinued operation under liability. The 6 you are seeing here is that one. Trade payables that you see on note 6. All right. So that is that. My battery is low. We've spent almost 2 hours already on this same question. So what I will just do is, I've said, I'm going to put our numbers together. I'll watch the recording. I'll put our numbers together. Have the same balanced position. If I have done what we have done so far, even if you ended up not even presenting, maybe time was not enough. You ended up not presenting, the full cost of it is the workings, because that's where you're going to end mark. Done. Let's say the same pencils up as you were putting it together. Don't worry, you've done enough. You've done very well enough. All right, thank you. I'll see you in the next class. But before then, I should have sent you the solution using our numbers. Secondly, is that there's a possibility I'll reach out to us during the week so that we can do the other question. I have no fear again that this is night match. I have no fear. At least we'll have like additional 6 that we can still cover. If you are able to do a question during the week, you'll be able to do by Friday. Then by Sunday, we'll just go into group cash flow. All right, thank you, everybody. Have a lovely night rest. I'll see you next week. Thank you, everyone.
Thank you, sir.